Audio Jungle.
Hi, welcome to the interview with Value Investors. My name is Cayden Chang. I'm the founder of MindKinesis Value Investing Academy. And this afternoon, I'm really honored and privileged to be interviewing Professor George Athanassakos. Now, Professor George Athanassakos is the Professor of Finance and the Benjamin Graham Chairman in Value Investing at the Richard Ivey School of Business at the University of Western Ontario. Now, in the next couple of moments, I'll be asking Professor George Athanassakos a couple of questions regarding how retail investors can reach their financial goal using a proven formula known as value investing. So, Professor, if you don't mind, can you just share with us what is value investing? Thank you.
Okay, so value investing is a style of investing that was developed in the early 30s at Columbia by Ben Graham. And Ben Graham showed us a way, an approach, to find and buy stocks that trade significantly below intrinsic value. So he showed us a way on how to find stocks on sale. In a layperson's term, a value investor wants to buy an asset that is worth $1 for 50 cents. And the whole idea is how you do this. And the value investing process has 3 steps. In the first step, we're looking for possibly undervalued stocks. So what are these possibly undervalued, and how do you find them? Well, we're using a screening approach. We screen stocks by price to earnings or price to book. That is, we want to find stocks that have low valuations vis-a-vis accounting numbers. Okay, so so from the first approach, from the first step, from the screening, we isolate these possibly undervalued stocks, maybe 50 Hutton stocks. Then we take these 50 Hutton stocks into the second step, which is the step of valuation. And in valuation, we try to value the stocks in depth, in detail, to understand the business, to understand the economy, the markets, the competitive situation, who has competitive advantage, who does not, to understand the management. And at the end, we end up with an intrinsic value for these 50 Hutton stocks. Step number 3, we're making the investment decision using the concept of margin of safety. That is, we will not buy a stock unless the stock is 30% below, like, I mean, Ben Graham used to talk about 50%, but contemporary value investors are using about 30%. So we will not buy a stock unless the stock is 30% below the intrinsic value. And we follow these 3 steps with patience and discipline. And we have a long-term perspective. Okay, so that's in a nutshell, in brief, what value investing is and what the value investing process is all about.
Thank you, Professor. Now, next question goes something like this. Now, for those people who involve in or dabble in the stock market, there are 2 categories of people. One, they call themselves traders or speculators, and the other category, they call themselves investors or value investors. So in terms of generating return, in your perspective, now what would be a better choice, and why is that so?
Well, value investing is the long-term strategy, long-term investment approach, and has a proven record. Both academics and practicing investors show that it works. And you know, you can mention some names, of course. Buffett is one that comes first in mind, but other people many people don't know, like Walter Schloss, Irving Kahn. In Canada, Francis Chu, Peter Candle. It works. And what value investors do, try to minimize risk and protect the downside, protect the capital. Speculators is those who are trying for a quick profit. Yep. As value investors, we don't go for home runs. We go for steady and slow. So the speculators go into what is hot, what is in fashion, what is glamorous. And they're trying for a quick profit. But there's no easy way to make a quick profit. And what they eventually try to do is they try to maximize risk because they think, you know, the higher the risk, the higher the return. In theory, this is right. But in practice, it doesn't work like this. Because for higher risk, higher return, there are a number of assumptions you have to make. And these are very strong assumptions. For example, for this to work, the markets have to be always in equilibrium. That is, the stock price has to be correct all the time. And that we know with certainty what the average return is, average expected return, and what the risk is. And to be able to measure risk properly. These are very strong assumptions. In real life, this doesn't work. And you know, in speculating, the odds are always with the house. Okay? In the long run, the best you're going to do is break even. And the worst, you're going to lose all your capital.
The brokers always win.
So, yeah. So no question, value investing is what works and what people should do and should have a long-term perspective and should be patient and disciplined.
Thank you. So in value investing, there appears to be many criteria in selecting a great company. So what would be maybe just one or two of the important qualitative and the quantitative criteria in selecting the company?
Yeah, you need, I guess, both. You need qualitative analysis and quantitative analysis. Qualitative analysis is like understanding, I guess, the business of a company, the business model, understanding the competitive situation, who has competitive advantage, who does not. Is the market a free entry or the barriers to entry? You have to understand the management. Now, these things are not easy to grasp right away. You need some experience, some intuition, and the more you work at it, the better you become. The quantitative is also useful. You need both of them, qualitative and quantitative. The quantitative is primarily involves the three steps I mentioned. You use a screening approach where you screen stocks by P or price to book, and you're aiming at a low price to earnings or price to book. Then you value the stocks using some approach of valuation. We're going to learn tomorrow, next week in class. And third, using the concept of margin of safety to protect the downside, basically, and to find stocks that you feel are truly undervalued. Okay? So both approaches. The quantitative, it's easier to teach, faster to grasp, but the qualitative is also very important, but needs more time, more experience, more intuition, and so on.
Thank you. Now, for a retail investor, now what would be the ideal portfolio of companies that they should aim in terms of the number of companies they should own, as well as the companies across different industries?
You know, academics, you know, talk too much about diversification. And a key tenet of modern portfolio theory is that you hold a very well-diversified portfolio. Now, if you talk to Buffett about this, you're going to say this is nonsense. Buffett says, if you understand what you're doing, diversification is undesirable. And this is also what, you know, John Maynard Keynes was advocating and talking about. So you don't really need a huge portfolio to minimize risk. In my mind, a portfolio of 20 stocks, about 20 stocks, that you chose using the value investing approach, which involves, remember, the margin of safety, spanning maybe 4 to 5 industries. Why 4 to 5 industries? Because you need to understand, to make good investments, you have to understand the industry. And we cannot understand too many industries. Okay, so you've got to spend time to understand 4 or 5 industries very well. And then invest. I mean, there are like, if you choose 4 to 5 industries, you can find like 1,000 stocks in these 4 to 5 industries. But again, you know, I mean, you've got to do all this stuff with, to develop a skill, I guess, to learn, and to do all this stuff with patience. And it needs time as well. Yes. Now, if you don't have time, if you don't have patience, you don't have skill, do what Buffett says to do. Buy an ETF. Index fund, yeah.
Okay, thank you. Now, the last question goes something like this. Now, for a retail investor with very small capital of ranging from 2,000 to 3,000 US dollars, now how can they get started using value investing?
So the amount of money is not really very important. It's understanding and learning the process and building capital slowly over time. And remember I said, we don't go for home runs. We don't expect to become rich in 1 year. Give yourself 3 to 5 years. But you've got to learn the process. And you've got to learn it right. You can go and read all the books out there about value investing. No one actually tells you exactly what they do. They give you some nice stories, but they don't tell you exactly how they do it. And I remember I had invited in my class, one of the famous Canadian value investors, Peter Candle. And he talked to us about value investing. And then I said to him, okay, cut the chase, Peter. I said, tell us how you do it. And he said, well, by osmosis. So no one will tell you how they do it because that's the competitive advantage. So young people should try to learn the process right for people who understand the process and who don't have a conflict, who don't manage their own money so that they say, no, I cannot teach you all my tricks. And unfortunately, there are not too many universities that do this, can help you do this. The only 2 schools that have a rigorous academic value investing program is at Columbia and at Ivey. And you can't do it without educating yourself. And the nice thing, I guess, about making your own investments and understanding what you're doing is that you are in control. Okay, because no one will protect your back. It's your responsibility, okay? And it feels so much better when you are in control. If you don't want to be in control, buy an index fund.
Now, Professor, if there's one last piece of advice for the Singaporeans, what would that be?
Well, educate yourself in the value investing process and be disciplined and patient. There's no easy way, okay? There's no fast way to make a quick buck, okay? You've got to have a long-term perspective and build your capital slowly. That's it.
Thank you. This is Cayden Chang, together with Professor George Athanassakos. Now, see you back home. Thank you.
Audio Jungle.